This is Trepp Wire Week in Review for week ending February 5th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, Joe McBride, Head of CRE Finance, and joining us this week is Vivek-Anand Dattani, Head of our European office. This week, a rollout of more vaccines for states, and Democrats push ahead with their stimulus package. This as COVID cases, hospitalizations, and deaths drop from their January peaks. And economic data is showing some green shoots. Manufacturing grew last month. Initial jobless claims were down last week to the lowest since November. ADP employment numbers beat expectations, and sentiment is the January jobs report tomorrow will essentially hold at 6.7%. The market is up, but some of the stocks that were at the center of attention last week haven't done so well. But first, Vivek, there's concern over the new strain of COVID in the UK. What's the latest?
Yes, so thanks for having me back. It's great to be on the podcast again. So the UK began door-to-door testing on Tuesday to curb the spread of the highly infectious variant that originated in South Africa. So there were 11 cases that were found, but this campaign is going to involve testing 80,000 people across 8 different areas. And the government have issued an executive order to all council workers, no matter what department you're in. If you're in one of those areas, you actually have to go and go to people's doors, knock on the door, give them a test, and return later to collect the results and tell them whether they quarantine or not.
When they knock on your door, do they ask you which letter encyclopedia book you want to buy from them?
They do. That's the added commission bonus that to pay for this. Exactly. But it's really interesting as well because quarantining in hotels is about to start on the 15th of February. And essentially, owners of hotels are going to be asked to provide accommodation to 1,000 people each day. And passengers will have to stay in those hotels for 10 days. And security guards are going to be accompanying the passengers to make sure that they stay in those hotels. So some may say a little too late, but I'm just glad that the government are now putting in these measures.
So sure. Vivek, do you have the blue check mark above your front door? Well, on Twitter, if you are a verified person, you get the blue check mark that tells you, tells people that you are the real Donald Trump or the real Jeff Bezos or whomever it might be, the real LeBron James. So somebody started a scam last week where they said you could apply for the blue check mark on your home. And it will tell your neighbors that you are a really important person. And the person who started the scam, it wasn't really a scam, it was a goof.
Like the pet rock. Like the pet rock.
Except I think he got something like 80,000 applicants for the blue check. And before you knew it, he had about $250,000 in reservations for people who wanted the blue check above their front door. So
give me 1 second. I'm just going to run outside with a blue marker pen. I'll be right back.
Well, it's like, capitalism and entrepreneurialism always finds a way. It's like the people in California who rent out a cardboard tube that on the inside looks like a private jet for you to take pictures on.
So going back to the week's events, Martha, you summed it up quite well. More positive than negative. A week ago, we were worried about the short squeeze of GameStop and AMC and Macerich and others potentially taking down the financial markets. At one point, Zero Hedge was estimating that hedge fund losses were $70 billion. We speculated that, there's a chance that that could metastasize into something more concerning, something that would spread to the banks. Fortunately, it didn't. We saw a lot of the high flyers from last week, GameStop and others, return back to earth. Which seemed to give the markets a real boost. Stocks were up most of this week. Earnings were very positive, especially in the tech sector. We did see progress on the vaccine front. It doesn't seem like family members are pitting themselves against each other to try to get further up on the line. We did see lower jobless claims today, and we saw the ADP jobs report, which came in well above expectations. So all of that led to a pretty positive week for people. And hopefully between the short squeeze, the concerns about systemic risk, progress on the stimulus, and more people getting vaccinated, we're on our way.
Well, we released our delinquency numbers this week and all major property types seem to have improved. Manus, take us through the numbers.
Another solid month of improvement. As people know, we saw a real spike in the number in May and June. We almost set a new all-time high in June 2020. We've now seen 7 consecutive months of decline. The rate this month was 7.58%, if I remember correctly, which is down from 10.3% in June. So steady improvement, improvement in most asset types, right? We saw about a 50 or 60 basis point improvement in lodging, although that remains stubbornly high, still 19% delinquent in the lodging space. Retail saw an improvement of about 30 basis points. It's at 12.7% as of January. So slow but steady progress, and that's a good sign. On the special servicing numbers, we saw an improvement there as well, but much more modest. The special servicing number dipped by 9 basis points. A small decrease in retail. It remains at 17% with the special servicer or workout specialist, as some call it. One area of concern is in the hotel space. The special servicing percentage there jumped from 24.1% to 24.5%. I guess that's not that much of a surprise when you consider that the second wave of COVID that started, I guess, in October really has hammered the hotels all over again, the ones that had seen progress over the summer and fall. So I guess it's not a big surprise there. If we're looking at areas of concern, we did see an uptick in loans in grace period. For those that recall, back in April and May, we said this was kind of the canary in the coal mine, that more and more borrowers were using their grace period before going 30 days delinquent. This month, we saw a 30 basis point increase. We're nowhere near where we were last spring, which was over 8% of the borrowers using their grace period. But it is inching up, and it's inched up for several months in a row now. And we did see a sizable jump really in all the heavy hit areas: lodging, retail, and mixed use. Actually, mixed use saw the biggest jump of all, which sometimes that means street level retail in offices or multifamily projects is really weighing down on a property. When we look at watchlist, another forward indicator, that went up almost a full percentage from 21.4% to 22.3%, a 3% uptick in the hotel segment, and a modest improvement in retail. We peaked at about 10.5% in September. I would say there's some churn, right?
Yeah.
What we're seeing is new stuff being added every month, but some stuff that has been resolved either through forbearance or modification gets kicked back to the master servicer. So this may stay range bound for a while as this kind of cycle continues.
For me, that's the number that I'm kind of looking at. Like when that starts to actually trend downward over 3, 4, 5 months, that's when I'll really know that we're doing better. Because I do think that a lot of these quote unquote cures that leave the delinquent bucket are really not true cures. You know, they're forbearances that we're going to have to deal with 3 or 6 months down the line.
Vivek, before we get into some of the CRE trends in the UK, in addition to heading up our European operation, you're the chair of the Trepp MERG group. Give us a quick overview of what that is.
Sure. So we formed our multi-employee resource group back in July of 2020 to essentially create a foundation for Trepp to address every difficult conversation and create an open environment for our employees to grow both personally and professionally. For example, this month, we're celebrating Black History Month. We've sent out a really good piece of content celebrating those key Black figures throughout history. And we're holding 2 events. And the first event will be educating our employees on the Black Lives Matter movement. We are looking for industry participants to collaborate on initiatives and events. So if you're part of your respective D&I groups within your organizations, please do reach out to us.
Great. And my understanding from working closely with the group is that clearly this is to help with retention, recruitment, professional development of employees. So a number of your initiatives are first to build awareness and then obviously to assist in those endeavors.
Yeah, something that I appreciate about the group is it's got many benefits. And one of them is that people within the company talk to other people within the company that they otherwise wouldn't, So we do have some, what do you call it? Cogitation or coagulation or what is it? Oh, what did Jamie Dimon call it? He called it creative combustion.
There you
Right?
go.
We get a little creative combustion out of
Sounds
the
better
merged
than
group.
coagulation.
Well, that happens too, I guess.
So let's turn to some of the UK CRE trends. Vivek, walk us through some of the alignment in property sectors like retail and office and what you've seen.
Sure. So CRE investment volumes across Europe actually fell by 17% last year to 275 billion euros, which was actually better performance than was initially expected due to the pandemic. And the larger investment markets was Germany, the UK, and France. This year, the strong appetite is for logistics and multifamily assets, and it's expected to continue. We can definitely expect to see a high demand for core office properties with high quality facilities, life science assets, and UK assets following, of course, the agreement of the Brexit deal. There's also been a huge increase in UK warehouse investment. Last year, online shopping increased by 46.1%. As a result of this, there has been a higher demand for warehouses of all sizes with investment in distribution warehouses, increasing by 25% in 2020. I just want a quick segue into European CMBS because European CMBS started coming back in 2018. And then last year we kicked off really well, but then COVID happened. So there was only about 2 billion euros worth of European CMBS issuance. But that being said, with all the increase in interest in warehouses and the financing for those warehouses, hopefully that's a positive sign for European CMBS. And then the final point that I just want to talk about is a few household names and what we're really seeing in the UK CRE sector. Debenhams, which has been around for years. I remember going when I was much younger to get my school uniform from there, my first suit from there, essentially entered administration last year. And they were going to be bought out by JD Sports. However, JD Sports pulled out due to the collapse of Arcadia, which is their parent organization. More recently, there's been news that Boohoo.com, which is a sort of throwaway fashion online retailer, has bought Debenhams for £55 million. They'll be closing all the stores and they'll be moving all of Debenhams' merchandise online. And their expansion plans are not stopping there. Boohoo announced that they're in talks with Arcadia to acquire Dorothy Perkins, Burton, and Wallace brands. So if you go into any UK shopping mall, these are shops, individual shops that you would see. And they're planning the same thing, get rid of the shops and move them all online. And then a company called ASOS, which I'm sure many of our listeners know. ASOS bought more household British names, Topshop and Topman, Miss Selfridges, from Arcadia for £295 million. And they're following a similar strategy to Boohoo. They're moving all these shops online. Quite bad news for the current high street. What I'm really interested in is what they're going to be doing with all this space that's now available with all these empty shops.
That's kind of wild. I can't, can you think of a parallel in the US, Manis? I mean, I think that I don't know. I'm thinking of like an online first company buying a brick and mortar retailer. I feel like the online first companies are just going at it themselves, right? Like
We did see it, I think, with
one.
Authentic Brands. I think they bought Barney's to take them private, and I think they've bought a couple of others that they had the same idea with. But every now and then you'll see somebody purchase one of these just for the IP, right? Just for the e-distribution. It's usually not something that you use as a beachhead to grow into something new. It's to add to, at least in the US, a swath of products you already have to grow your bandwidth.
Yeah, I wonder what the details are of these purchases, because I would not want to be the one purchasing a company that is on the hook for, 100 stores leases. You know what I mean? So they must have some sort of plan in there, or they're just purchasing the brand assets and they're not purchasing the operating company or something like that. I don't know.
Well, here in the US, normally it's bought out of bankruptcy, and a lot of times it's a pre-pack. That's what's happening right now with Belk that we mentioned last week, that they're only going to spend 2 weeks in bankruptcy. The deal has already been brokered, and how it's going to turn out. But the process of going through bankruptcy allows the firm or the acquiring firm to reject leases. And I think that that's a big part of the appeal.
I just want to say that I'm looking out my window and I just saw an Amazon truck drive by right as we were talking about this. It's almost like the truck was like that smile, you know, the smile Amazon logo. It was like laughing at me and us talking about the retail space as it drove by.
The interesting part about this, about what I've just talked about, is Boohoo 2 years ago were facing a huge public backlash because they basically created clothes for really cheap that people would wear once and throw away. So the economic impact of these type of organizations is bad for the planet. And now they're buying out all the bricks, the household names in the UK. And I think to Manus's point, expanding their offering essentially.
Vivek, knock, knock.
Who's there?
Boo.
Boo.
Don't cry.
So Vivek, in contrast, similar to the US, grocery stores are doing very well.
We've seen that grocery stores have done very well here, of course, because they're one of the few types of retailers that have been allowed to trade during this time. The increase in sales and great performance, they really just recruited so many people in their warehouses, delivery drivers, to really get essentials to the UK population. And this has led to an increase in demand in real estate. And to be honest, a very competitive grocery market in the UK.
And in office, you've seen a bit of a bounce in high quality office.
We have. So we started seeing this trend with CLS Holdings, who are a British commercial property investment company, and they acquired a German office portfolio of high quality, well located assets for around 90 million euros. And also AXA Investment Managers, they've completed a huge redevelopment project called Freedom, which is a 1960s office building in Paris. The project involved a shift to a more eco-friendly, high-quality office space that contributes to enhancing the local ecosystem with energy-producing glass walls, maximize the cost to light, and a cost to the gardens, and so much more. Next time we can travel, I'm definitely going to go and visit that property. It sounds very cool.
Back in the US, let's look at some of the retail news that we've seen. Brookfield was in the news, Simon was in the news, and not for good reasons.
Brookfield had their earnings call this week and their earnings announcement. They showed a big loss for the quarter. I read through the transcript. You know, one of the highlights or lowlights, as it may be, for CMBS investors is that in answering a question, one of the speakers said that they have about 20 malls now that they're trying to decide what to do with because they are at or around the balance of the loan, their CMBS loan. So it's probably a bigger number than I expected. Usually when you get to that point where the valuation is the same as the loan balance, either you are going to your workout specialist asking for relief, right? Some kind of modification that reduces your loan balance, your interest rate, extends your maturity date, some combination of the three, or you're tossing back the keys. And that's, I guess, the decision being faced right now with Brookfield on many of these malls, a couple of which have already been flagged as likely to come back to the borrower in short order.
A lot of these are the old GGP malls.
Well, we don't know for sure. There's 20 that are.
Well, we don't know which the 20 are, but I'm saying Brookfield property is what subsumed
right, exactly.
GGP.
Yes.
So it could be we could be seeing the same story kind of repeated here.
And we saw a Simon Mall that we've talked about before in Atlanta fall to foreclosure.
Yeah, last week we talked about the big catastrophe for CMBS longs and the big spiking the football, if you will, for the CMBX shorts of the Las Vegas mall that had been valued at 125 million. It was sold at auction at 1.5 million, which was a fraction not only of the original value, but of the carrying value of the servicer data in the CMBS reports. We anticipated that the loss on the asset would be more than 100% of the loan balance because there's $20 million in unpaid advances and so forth. So for listeners that are looking for a candidate for the next one that could be following this path, albeit maybe not as dramatically so, it could be the town center at Cobb. The loan became REO this week. It is a Kennesaw, Georgia property. It has JCPenney and Belk as tenants. It once had a Sears. Sears left a couple years ago. backs 177 million in CMBS debt, all of which falls into two CMBX 6 deals. The property was valued at 322 million in 2012, down to 130 million last October. Now that it's REO, we would expect the special servicer to move quickly to either get this to 10x for an auction or some other broker who can move this along. So if you're looking for the next deals that could be impacted and see real reduction or destruction of their subordination levels, the two deals that own the town center at Cobb would be candidates.
So Manus, we've done the very exciting educational segment on CMBX in the past, but let's do like a quick thing here. There's a short side of the trade and a long side of the trade in CMBX, right? And in this case, CMBX 6, references a pool of 25 CMBS deals from 2012. A lot of mall loans are in those deals, right? That's kind of the background. But when something like the Prism/Fashion Outlets mall story that we talked about last week happens, where it's going to be a 70 million plus loss, 100% plus loss, what does that mean for the trade, or what does that mean for the long and the short side?
Well, I'll try to do this as quickly as I can. Normally, when something like this happens, when the outcome is worse than anticipated, what would happen is that the price of the short would get more in the money, right? Their profit would grow. So let's say, for example, I haven't looked at it lately, but let's just say CMBX 6 triple B minus right now is spreading, for argument's sake, at 2,000 basis points, and it has a dollar price of 60. If you have a worse than expected outcome, you would expect that price to fall even more, maybe from 60 to 58. So that if you were the short guy, you've made 2 extra points on your trade. And if you were to go unravel this trade now, either by sloughing it off on somebody else or by going back to the long and saying, let's resolve this, you're $2 more to the better. And that comes out of somebody else's hide. And if you're the long, you're paying $2 more today than you might have thought you could have resolved this at a week ago when you thought the outcome would be slightly better. In this case, when this is resolved, it looks like the loss will be into the triple B minus class. And at that point, you have a trigger. And the loss that the owner of the short has in that month, let's say it's $3 million, whoever is long that, they've basically written insurance and they're writing a check to the short for $3 million to cover that loss. And the same is true of interest shortfalls every month. So there will be money.
That's kind of that's what I was trying to get to is, we've been talking about spread movements and price changes on CMBX this whole time in COVID times, how the spreads have blown out. It costs a lot more to buy protection, which makes sense, or to buy insurance. But now this is one of those, what is it? Roosters coming home to roost, or what is it called again?
Chickens.
This one chicken is coming home to roost, the fashion outlets. And the way that happens is the short actually gets a payment from the long to recoup the notional loss. And the thing about, I think, and I'm not, we should have some CMBX experts back on to kind of walk through the logistics of the plumbing of this stuff. But let's say it's a quote unquote $3 million loss to the bond. That's just a fake number. You could be levered up 10 times on that, right? Like it's not a one-to-one ratio. It's not necessarily a one-to-one ratio. Like you can take out insurance on this bond and do a notional balance of 100 million, right?
Sure.
Yeah.
The shorts could have gone to 10 or 15 money managers with the same trade.
Right.
And done this over and over and over again.
Right. So it's not, it's similar. It's like that when we were talking about CDS back in the day, right? Like I can take insurance out on my home and I can really only insure the value of the home once. But in this scenario, you can insure the quote unquote value of the home as many times as the long side is willing to take on the exposure.
That's right. You see the termites in the neighbors next door and you say, not only do I want to insure my house, I want to insure it at 100x.
That's right.
And one more story, the Kroger company is closing 2 supermarkets. And it's an interesting story because it's due to a municipal law.
Yeah, we wrote about this week in Trepp Wire. The loan at hand is about a $40 million loan backed by 5 grocery anchored properties in California. One of them they're all Kroger stores under the names of either Ralph's or Food for Less. One of them is in Long Beach, California. Long Beach, California just passed, or is advancing. I don't think it's passed yet. It's advancing a law that would require grocery workers to get an extra $4 per hour under a hero pay, quote unquote, act during the pandemic. And Kroger's said, we will be closing that Long Beach store because this was not that profitable to begin with. And our lease is coming due in April and we're done. And so Kroger's getting a lot of blowback for, an unwillingness to pay the $15 an hour or whatever it is, the extra $4, whatever that amounts to. And, they're making a business decision. And I think that as the $15 minimum wage works its way through the Biden White House proposals and the stimulus package, I think you'll see more and more of that. And it's not a value judgment on my case. It's just the way of life that some firms will automate and some firms will not be able to make it and some will. And that's just the way economics works.
I think we should put that as a subtitle to our podcast. That's just the way economics works.
But it's, one of my gripes throughout the pandemic, and it's a gripe in kind of in general, is that, all these issues that we fight about today, details matter, right? With things like this. And in New York, just to give an example, waiters and waitresses often only make $2.67 an hour. That's their baseline rate. And the rest is made up of tips. And if the tips don't add up enough to make up to minimum wage, the owner, makes up the rest. Now, the way the law is being written, the $15 comes in addition to tips. It's not a bottom, it's in addition to. And what I think you're going to see out of this is, well, one thing is restaurant owners will say, we can't do this. This is the final straw that breaks the camel's back. But others will say, okay, this is no longer a tip industry. This is $15 an hour. We're done. We're keeping the tips. And it amounts to, in that example, a pay cut for waiters and waitresses that are working at high-end restaurants. No matter what issue we're talking about, whether it's taxes or best practices, for the economy or for hiring or for anything else, details really matter. And I think there's a shortage of details.
Well, I have 2 points, then we can move on. First is, I think that story in California is a microcosm of, what we're going to see? We're just going to see more and more people working for Walmart and Amazon, and fewer people working for smaller businesses, because Walmart can afford to pay people $15 an hour, right? And so can Amazon, and so can other really, really large corporations. But Kroger's not a small company, but I'm just saying, the small coffee shop or restaurant down the street may not be able to afford it. The other point I want to make is in sophomore year of college, I did a month abroad in Dublin, Ireland. And one of the first things that they had to tell us was, hey, over here, they don't really have that whole tipping thing, like waiters and waitresses and bartenders get paid more here. So you don't really have to tip like you do at home. And it was so antithetical to my being. Like, it was so hard. I had to leave a tip. I mean, maybe I left a smaller tip, but like growing up in the US and especially in, lower Westchester and the Boogie Down, all those different, the world runs on grease. So I'm a big grease guy. And even if I'm over in the UK, I'm still going to be greasing palms.
You'll be the waiters and waitresses' favorite customer, Joe, because over here we just don't do it. Someone has to remind me when I come to the US remind me that tipping, you have to tip over there, because obviously over here we're so used to not doing it.
Yeah.
So
I could see people asking Joe, do they have polygamy in the United States? Like, I love you. Will you marry me? Will you take You're just
Listen.
throwing bills everywhere.
Oh my
Greece
gosh.
translates in all languages. I thought of like Jimmy Conway walking into the room, putting 20s in everybody's pockets.
So turning to multifamily, speaking of legislation, we've seen a number of states that are taking action by extending an eviction moratorium or providing rental assistance. In California last week, passed legislation that was to do just that.
Yeah, so we put out a blog this week covering the high-level details of some of these eviction moratoria, plural. One of my favorite things to say. It's like consortia. So check that out. And we have a link to actually another site that seems to be doing a very good job of going through each state and putting their kind of what's going on in that state. So I'll just kind of do a quick overview here. What I call the Fauci moratorium, or the CDC eviction moratorium, has been extended until at least March 31st, 2021. And it prohibits landlords nationwide from evicting tenants. And essentially, you are eligible for this as a tenant if you have tried to get other housing assistance. You're unable to make your rent payments even after that assistance, or maybe you couldn't get that assistance for some reason. If you are going to earn less than $99,000 as an individual, or $198,000 filing jointly. I mean, this is kind of where the details question comes into play here, because if we really wanted to do this correctly, the numbers would be based on what rents are in each market. So someone making $99,000 somewhere in middle America and they're renting for $700 a month, that guy's living like a king, versus someone making $99,000 and trying to rent in the Upper East Side or something like that. It's a lot more challenging. So, but anyway, that's kind of the broad stroke that they've brushed here. And then if I just kind of scroll down the list of all the states, it kind of flows or follows what you would expect, right? I mean, generally, more conservative states have less holds or moratorium. You know, right here, I'm looking at Alabama, Alaska, Arizona, Arkansas, no. Surprisingly, Colorado, nothing really. But then, you know, California, New York, DC, Illinois, they all have some form of their own eviction moratorium in place. Some of them, you know, through March, some of them longer. So, you know, coming back around to a little bit of what Vivek was talking about with the hotels too, but, you know, there is going to come a time here where a larger question needs to be asked, which is, if I own a property and I don't have any say over what I can do with that property or who I can let live in that property, do I still own that property? Right? I mean, part of owning an apartment building is you being able to manage, you know, within all of the laws, you being able to manage who lives there, you being able to remove people who can't pay or who don't pay. So I don't know how much longer this can last. I mean, maybe like Manis mentioned last week, it can last a really long time for all of the landlords who have Fannie or Freddie loans, because Fannie and Freddie, it rolls up to the government and they can just continue to forbear and forgive and kick the can. But, you know, it's really, it's a little bit of a worrisome situation, right? Like, yeah, we're in some serious, again, here's the word, ready? Unprecedented times. But, you know, if we set this precedent where we can't evict people, then the whole value proposition of investing in real estate, making apartments livable, you know, investing in different areas and neighborhoods, it kind of changes.
So the California law allows, if landlords opt in to the program, they get 80% of the tenant's rent paid on behalf using the federal stimulus money. If they opt out, the tenants can apply for assistance for up to 25%. So the landlord has to agree to forego collecting that other 20%. They'll get 80% of the rent paid. So it's not an ideal solution, but it does seem to address some of the landlord pain right now.
Yeah. And, you know, I should say that I'm sure that the stimulus that they're trying to work through right now is going, I know it's going to include many, many billions of dollars to probably more to states like New York and Illinois and California. So maybe the pain won't be as bad for the landlords. But I just think, kind of as a principle, if I'm looking to invest in multifamily assets, I'm probably thinking more towards states where I have more control of that asset, in the future. And I would say, I should give Donut Shorts another shout out. He was, this was actually Pink Polo Shorts that Donut Shorts on Twitter referred me to, who was saying that the bid right now in Manhattan for lending on, let's call it high price multifamily is very, very sparse. So, that's just one kind of anecdotal data point. But, if I'm looking at lending to a multifamily owner and he's in South Carolina or, one of these other states that has less lockdown and less eviction restrictions, I'm probably much more apt or willing to lend in that area versus looking at something in New York City or California or San Francisco. That segues me into a couple of things that I was just looking through. So I was looking through some REIT earnings, and, I'm just generally interested in multifamily myself. So that's why I was kind of looking at multifamily in particular. And a lot of them haven't reported yet, but two that have are Avalon Bay and Mid-American. So I'll just go through a couple of data points here that I found. So just, this is the dichotomy. Avalon Bay is generally, let's call it higher end luxury rentals in, coastal markets, more primary markets, whereas Mid-American is exactly what it sounds like. It's more Sunbelt, less primary markets. So Avalon Bay, their funds from operations were down 18.9% in the 3 months ended December 31st compared to last year. So, funds from operations is really kind of like what everyone looks at when they're looking to judge how REITs are performing. And they have another chart here which talks about changes in rental revenue. So lease rates were across the board year over year down 2.2%. Concessions and other discounts added, or I should say decreased another around 2%. And then what they call economic occupancy was about another 2%. I should say 1.7, 1.6. And then uncollectible lease revenue was 2.1%. So all in all, they were down about almost 8% in total residential rental revenue. So New England, Metro New York, Mid-Atlantic, Pacific Northwest, Northern California, Southern California, all negative on the rental revenue in the kind of 5s and 6s. On the net operating income, NOI, negative double digits, 12%, 11%, 13%, 18% in the Pacific Northwest, 19% in Northern California. Now in their expansion markets, which are South Florida and Denver, they were actually relatively flat. So, I know I'm throwing a lot of numbers here, but, the thesis is that these big primary lockdown markets were bearing the brunt of multifamily pain. Now, if we go to Mid-American, they had a really great breakdown of all their different markets, and I won't go through them all, but I'll name a few here. Places like Atlanta, Dallas, Charlotte, Austin, Orlando, Nashville, Raleigh, Houston, et cetera, right? There's about 20 markets here. Not one of them has a negative growth rate on revenues. Maybe like one or two of them have negative growth rates on net operating income, and that's mostly due to increases in expenses. And average effective rents, all positive, right? Some of the higher ones are Phoenix at 6.6%, Birmingham, Alabama, 5.1%. That's good. I was actually looking at something in Birmingham this week. Huntsville, Alabama, 9.2%. And their overall performance was strong. So I've been talking a while, but the point is that, we're seeing pain in the sectors that you would expect, and we're seeing, I'd say, less pain or some growth in those other areas.
And in office news, a couple quick hits. We saw that Colliers put out a Manhattan office availability number, which was 14.9% in January, the highest going back to 2000. I think that was a story that was appearing in Bloomberg. And real estate startup Notel filed for Chapter 11.
So let me just jump in real quick. I just wanted to throw a plug in here. Speaking of office, We are working on a piece with CompStack, who we have a partnership with, on kind of sublease availability and some other office stats. But I do want to throw the plug in there that we do have a ton of CompStack data on our products, on our platforms, that shows actually lease rates, tenants, and other really kind of valuable granular information. So any clients out there who are listening who didn't really realize that, give us a shout at podcast@trepp.com.
And speaking of leases, we are going to go over some deals that Manus has been watching.
I'll give,
Deal of the week.
I'll go through some good news and some bad news. Let's start with the good news. Several new leases across different segments of the market. Beyond Meat, this comes from a story from Commercial Cafe, 280,000 square feet in El Segundo, California. Gary Horowitz, Blake Surlis, Connor Hall, Camille Aga of JLL repped Beyond Meat. Jeff Pion of Newmark repped the owner, which is Hackman Capital Partners. So great to see that get done. From Commercial Property Executive, HNA, who is out of China, big property owner, owns several large New York City apartments. They closed 225,000 square feet at 245 Park Avenue in Midtown Manhattan. That one's interesting because JP Morgan is the top tenant. They are using it for overflow space as they build a new headquarters in Midtown Manhattan. It'll be interesting to see what they do once that new tower is done. But in the meantime, HNA got $225,000 in renewals. Another major tenant with a lease expiring soon at that property is Major League Baseball. And with that, we'll note that pitchers and catchers report in another 10 days, which we're very happy about. Also from Commercial Property Executive, Freshly, 92,000 square feet at 28 East 28th Street. That's a George Comfort and Son building. It used to be known as 63 Madison Avenue. Loomis Sales, 232,000 square feet of extension in Boston at One Financial Center. Ron Perry, Larry Epstein, and Matt Perry of Avison Young repped Loomis. Bill Anderson, Dave Martell, Allison Kavanaugh of Newmark repped the owners, who are MetLife and Norges. Andurel Industries, a defense contractor, the biggest lease in Orange County, California in 15 years, 640,000 square feet in Costa Mesa, California. That building owned by Invesco and others that I can't read in my notes. Beam Suntory, which owns Jim Beam whiskey, I guess that is, right? Hard alcohol, 100,000 square feet at 11 Madison Avenue in the Gramercy Park area of Manhattan. Unfortunately, Beam Suntory will be leaving Chicago. That's now 15 or so firms that we've seen either offer sublet space in Chicago or announce a move. So those are our leases of the week. That's the good news. The not so good news, one of the stories Martha already noted, Knotel, the workspace sharing provider, filed for bankruptcy. We listed on our website all the CMBS loans for which the buildings have Knotel as a tenant. Great work by Max and Catherine at our New York office putting together that list. WeWork also announced many location closings across the US, some of which touch CMBS loans that we also wrote about. More sublet space. These are more negative stories. This via the Seattle Times. Nordstrom moving out of 360,000 square feet of office space in Seattle. They will still have 700,000 square feet in that city once they're done. Yelp looking to give up 60,000 square feet in Chicago, 270,000 square feet in New York City, and 160,000 square feet in San Francisco. So Yelp really looking to contract. And Price Waterhouse-Coopers, PwC, this according to The Real Deal, they have 800,000 square feet at Brookfield's 300 Madison. That backs a single asset deal. Another 240,000 square feet at 90 Park. That's owned by Vornado. They are quietly offering some of that space out there now looking to reduce their New York City footprint. So that's a lot of what we saw over the last week. If you have any questions on those deals, reach out to me on LinkedIn or podcast@trepp.com, and I'm happy to answer any questions you have.
I have two claims to fame on one of those buildings you mentioned there. So 245 Park, where MLB is, I gave Rob Manfred a head nod in the lobby when I was waiting to go up for a client meeting. And then I think one of those Madison Avenue properties you were talking about, on the walk to work one day, about 7:30 in the morning, I saw Spike Lee sitting on the curb on his phone with an iced coffee. And I said, "What's up, Spike?" And he gave me a head nod. So nice. I really miss walking around Midtown Manhattan and giving head nods to celebrities.
One of these days we'll have to do our best of celebrity head nods segment where we list our top 3.
We should do like favorite. One a week, because you have like 50. I have probably 0. 20.
Yeah, sometime in the future.
So Manish, you had a couple of sales that you wanted to highlight as well.
One was kind of interesting in Las Vegas. Crossroad Commons sold. This is a story from the Las Vegas Review. It sold for $50 million, has a Dick's, a Whole Foods, and a Barnes & Noble. The reason this got my attention is that this was valued, this particular asset, at $36 million in 2007. So really at the height of the last run up in real estate prices, the last bubble. And now it's valued at, more than a third higher 15 years later, at a time when values are depressed in many markets. So just an indication that not all the news is bad news, especially when you have a strong retailer like Dick's and a grocery store in your property. A second one, this is really just human interest story. The San Diego Times Union reported that the Welk Resort Companies, which was started by band leader Lawrence Welk. Welk Resort is a timeshare provider, sold to Marriott Vacations Worldwide for $430 million. So again, a positive sign there. You wouldn't think that timeshares would be particularly attractive right now, yet the Welk Resorts traded for $430 million. AZ Big Media, Augusta Ranch Marketplace in Mesa, Arizona, sold for $12.5 million. It's also grocery anchored. It has a Basha's in it. It's a 1031 exchange. The buyer was repped by Dom Capital. The seller was repped by Velocity Retail Group and Ferris Lee Investments. Dave Chatham, Darren Pitts, and Eli Castronova of Velocity, Dan McClellan, and Richard Chichester of Ferris Lee all worked on that deal. And as always, a big apology for any of my miserable pronunciations.
In corporate CLOs, Vivek, what's happened over the last month in European CLOs?
Sure. So European CLO issuance actually dropped 26% from around 30 billion euros to 22 billion euros last year. I know we talked about it last month, but I'll get on to that. And that's after 4 years of consecutive growth. There's also a very low to virtually no reset or refinancing activity due to the fact that liability spreads have widened. And so managers had very little incentives to reset or refi the deals. In the last month, there's been 3 new European deals that have priced and 5 deals that have either refied or reset. And it's showing that spreads are continuing to tighten. For example, issuance in January 2021 was 1.22 billion euros, and issuance in January 2020 was 1.3 billion euros. So pretty good start to the year.
Yeah, we put out some pieces on CLOs this week, kind of speculating how they would be impacted on this short squeeze stuff, right? A lot of the firms that were being short squeezed, like AMC and others, have presences in the CLO market. And last week, Joe mentioned that, some of these short squeezed entities it would be a good move to issue stock at elevated prices. Jim Cramer on CNBC the next day said the same thing, and he added the note about buying back some of their distressed debt with cheap equity.
Shout out to Jim. I know he's a loyal listener.
That's right. Maybe you guys have heard of him. The point being that these CLO managers who were prescient enough to buy some of the stuff at deep discounts 6 or 8 months ago might be taken out at par if any of these entities were to pursue this strategy, which would be a big win. Others, however, who may have invested with returns of like 13 or 14% recently, looking to milk the cash cow for some excess return for a few months, may also find the other side of the coin, which is I'm getting paid off at a time where I really wanted to see this enhanced yield for a while. So if you didn't see it on our Trepp Wire, look for it, and just some interesting machinations that could be byproducts of the short squeeze.
Well, listen, I'm no big proponent of 1.2 million people from Reddit going in and buying some random stock. But if you are going to buy some random stock, I'm pretty happy that it was AMC, because maybe for two reasons. One is AMC is a big tenant in a lot of commercial real estate properties, right? A lot of malls, a lot of retail centers. So they just got a lifeline, right? They got new financing anyway before this happened, but then this happened again and they were able to pay off some old high cost debt, right? Because they issued shares. So that's good for CRE, but more good or more better, if you want to use gooder grammar there, is that hopefully the AMC movie theater near me stays open for a while longer and open long enough for me to go back to the movies. I'm a big movie guy. I can't wait.
Going back to the European leveraged loan market and high yield bond market, just trying to link to what you were talking about, Manus, and then looking at issuance levels, they're expected to rise again this year due to the existing strong funding conditions. And this supports the expected rise in CLO issuance volumes this year that I was saying that we've got off to a really great start, since the trends between the two issuance levels have been closely linked historically. And finally, I just wanted to talk about the Dutch tax change. We reviewed this in our CLO Trepp Wire piece that we published a few months ago, but essentially this tax change applies a yearly 21% tax to management and admin fees to CLO SPVs. 16 managers have already started to migrate Dutch SPVs to Ireland after an attempt to appeal the ruling was rejected in October of last year. It was later announced that the tax implementation had been delayed for another 6 months. So during the next few months, we can expect to see more European CLO managers migrate Dutch SPVs to Ireland if they want to avoid this tax implementation. And Joe, I'm sure you had a great time up in Dublin during your trip that you were talking about earlier, and I wouldn't mind going and spending some time up in Dublin either, to be
Well,
fair.
if any of those CLO managers want to have like that one guy in the office in Ireland, like I can be that guy for you for a year or two, just to say that, hey, this CLO's stationed in Ireland and not in the Netherlands. I mean, I just love these stories because it's like, oh, really? Corporations are moving to the place where they can minimize their taxes? Like,
Shocking.
That's
the
what is it?
interesting
That's
thing-
how economics works, Manus said before.
The interesting thing about what you just said, Vivek, where the expectation of distress going up to 4 or 5% is that would be multiples of what we saw in the great financial crisis. The corporate CLO market really came through that particular period smelling like a rose, right? That was an extraordinarily benign period of time for that market. It'll be interesting to see how this compares.
And looking at shout outs, we had a number of great shout outs from folks that had all kinds of things to tell us. We had Mark E., who wore his podcast t-shirt in the blizzard. For those of you that weren't aware, the Northeast had a wallop of a blizzard this week. Joel
You should have
F.
seen me on the snowblower, Martha.
Oh my God.
I was painting my masterpiece.
Joel F., Jonathan T., and Bijit P. actually had a question about deed in lieu.
Yeah, we might have to do another educational segment about deed in lieu.
And a couple people requested access to our multifamily story. Benjamin R., Tracy, a number of folks, as usual, reach out on Twitter. Brian B., Ed M., Vincent D. Others requested access to our Catalina Small story last week. Graham O., Jason G., David A., George S., Daniel B., who's a professor at Florida State. And that rounds out our shout outs. And even those of you who are not football fans probably know that this weekend is the big game, and it's going to be a battle that pits the rising star against a legend, allegedly, I guess, depending on your point of view. What's your prediction, Vivek?
The Indians are to beat the Pirates 2-0.
Nice. Very nice.
Yes, you've done your research, I can tell.
We're going to have the first score safety, which usually pays like plus 5,000 or plus 10,000. Remember when that happened in the Giants Super Bowl?
That's right.
They sacked Brady in the end zone, and for the first score safety, I had a buddy who had that prop bet in there for like $100. So,
wow. Well, I will go with the Chiefs decisively. I thought the Chiefs defense, I mean, they're known for their offense. I thought their defense looked great last week in tying down the Bills. I think they're going to give Tom Brady fits. I'm thinking something like a 31-13 type thing. It's been a really great year for the Tampa area, right? They've had the Lightning win the Stanley Cup. The Rays had a great run in the baseball playoffs, but I think their football run ends Sunday at about 9:45 with a beatdown.
No, Brady's protecting his legacy.
well, you have the choice of two very, very good storylines, right? Storyline one is Brady is so historically great that he's able to go to a new team and bring them to the Super Bowl and bring them to the promised land. I actually think that it depends on those two linebackers that got hurt on Tampa Bay last week. If they're around, I think they have a really good chance. And you got JPP and Ndamukong Suh rushing the passer. But then again, Kansas City's offense is amazing to watch. Like Andy Reid somehow comes up with these crazy plays that you've never seen before. But because this is a podcast and because I have to take the opposite side of the bet for Madness. So I think I'm going to go with that storyline instead of the other one, which is Tom Brady is passing the torch to the next great quarterback in the NFL.
Also a good story. So we'll all have to eat some chicken wings and see how it turns out. With that, we'll close. And thanks to our producer, Haley Keene. Join us next week as we discuss what's happened during the week and how it may be impacting you. If you have a question or a comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the Trepp Wire podcast with your favorite provider. Thank you for listening and stay well.
All right.